and we're excited to have him with us to describe from an investor's point of view, from an investor's interest point of view, the need and the imperative for financial regulatory reporting to be transformed from documents into data. For the first time, as part of the Dodd-Frank financial regulatory reform, Congress set up an office within the SEC charged specifically with pursuing investors' interests, the first ever investor advocate of the SEC. Rick Fleming is here with us today. We are honored for that. Please help me welcome Rick Fleming.
Well, thank you, Hudson, for that nice introduction. Thank you also for the invitation. I've learned a lot today at this conference. It really is a pleasure to be with you today. It's also a bit daunting for me, to be honest, because I realize that I am probably the least knowledgeable person in the room about open data and structured data. I'm also mindful of the fact that some of you, while many of you are pretty conversant in securities regulation, some of you don't come from that world. So I'm going to try my best to sort of bridge the gap between my area of expertise and yours, and we'll see how it goes. I do have the privilege of serving as the SEC's first investor advocate, and simply put, my job is to provide a voice for investors as policy decisions are being made, not just at the Securities and Exchange Commission, but also at FINRA and the stock exchanges, the MSRB, all of what we call the self-regulatory organizations. I also report to Congress twice a year, and I can make recommendations about legislation that would be beneficial for investors. Now, one of the things that's different about securities is that much of the information that flows from a company to its investors actually goes through the SEC in the form of mandatory filings. And so the SEC's requirements for the collection and the presentation of that data is very important to investors and to the capital markets more broadly. And so today I want to discuss further ways that we can leverage technology to make this information more accessible and more meaningful for those investors. Of course, I got to give the standard disclaimer that the views I express today are my own, and they don't necessarily represent those of the Securities and Exchange Commission, the commissioners, or any of my colleagues on the commission staff. Now, since the adoption of the first federal securities law in 1933, disclosure has been a real foundation of investor protection. And under the securities laws, we don't have a situation where it's sort of a buyer beware kind of atmosphere. In fact, President Roosevelt, when he was recommending the first securities law back in 1933, asked Congress to flip that to a situation where we have let the seller beware. And from that, we have now a requirement that sellers of securities are required to disclose all material information to prospective investors. So under the securities laws, this idea of materiality is critically important, because that is the standard that controls the information that has to be provided to investors. Now, I don't want to give you a lecture in securities law, but in short, a fact is considered material if there's a substantial likelihood that a reasonable investor would consider it important in making an investment decision. Now, there are a variety of filing requirements under the securities laws, and we've heard a lot about different ones today, but for a few minutes I just want to drill down on two of the basic filing requirements with the SEC. First, if a company wants to sell securities to the general public, then it has to register those securities with the SEC by filing what's called a registration statement. And part of that registration statement is a prospectus, which many of you are familiar with. It's a pretty lengthy document, and it contains a lot of financial information about the company. It describes how the money from the securities offering is going to be used. It discloses the risks that are associated with the offering, and many other pieces of information are within that registration statement. Then once a company has gone through this process to do an initial public offering of securities, then the company is obligated to continue filing periodic reports with the SEC to make sure that the public has access to reasonably current information about that company to support what we call secondary trading in the securities markets. And as I've said, the fundamental purpose of all of this information that's filed with the SEC is to help individual investors make informed decisions about whether to buy and sell securities. But if you stop and think about it, this information also serves a very practical and important secondary purpose, and that is it helps to establish a fair price for securities in the marketplace as multiple investors make these decisions about whether to buy or sell securities at various price points in light of the most recent data that's available about a company. Now, over time, as so often happens, the length of these disclosure documents has grown. And so some observers, including SEC Chair Mary Jo White, have questioned whether disclosure may be losing some of its effectiveness because it's overwhelming to the average investor. And then there are other people on the other end of the spectrum that decry the increased regulatory burden on the companies that have to produce the disclosure documents. And so various efforts have been undertaken over the years to try to streamline the corporate disclosures that are made. In fact, under the Jobs Act, it actually had one of its lesser-known provisions was that it mandated the SEC to conduct a review of what's called Regulation SK, which is the regulation that contains many of the disclosure requirements. And the SEC was required to determine how that regulation could be updated to modernize and simplify the registration process and to reduce the burdens on smaller companies, on emerging growth companies. Now, notably absent, in my view at least, from that act or from that mandate, was any mention of the investors who use the information or whether that information would be considered material to those investors. Now, the SEC's Division of Corporation Finance has issued a report as mandated by the Jobs Act, and they've actually gone a step further, and they're now undertaking a review not only of the disclosure requirements of Regulation SK, but also the financial reporting requirements of Regulation SX. And according to Keith Higgins, who's the director of that Division of Corporation Finance at the SEC, the division's not only going to look for ways that those regulations can be updated to reduce the costs and burdens on companies that issue the securities, but they will do that with a view to preserving the disclosure of all material information to investors. And I think that's the right approach, because to me it seems entirely sensible to review the SEC's disclosure requirements to, of course, to eliminate any duplication there might be, and also to reevaluate whether all the items that are required to be disclosed are still material. And in fact, I would suggest, and others have suggested, that while we're doing that, we need to look for items that may not be required to be disclosed right now, but that would be considered materials, things that we ought to add to disclosure. But whatever we do in our search for disclosure that's less burdensome and more meaningful, the answer is certainly not to eliminate disclosures of facts that are material to investors. And here's where technology comes in. Because in my view, this technology actually provides us a win-win situation. And it's pretty unique because most of the issues that the SEC grapples with, it kind of pits the investors against the business community. But this is a situation where I think that technology allows us to benefit both sides of that equation. It allows the SEC to continue providing robust disclosure to investors in more meaningful and usable ways, while at the same time making the filing process less burdensome and more beneficial for the issuers. Now, I'm not the official advocate for issuers, but let me start with them for just a couple of minutes. First, I can understand their frustration with the SEC filing requirements. The corporate disclosures, as many of you know, are filed electronically, but they're in an HTML or an ASCII format. And the financial statements, some of the face documents, or the face financials have to be tagged, in XBRL, but the XBRL version is submitted as a supplement to the underlying document, not a replacement for it. So I can understand the frustration there. Now, I should confess that I've never actually personally submitted a 10K or an 8K to the SEC. But one thing I have faithfully done is file my taxes every year with the IRS. And I've thought about this, and I honestly can't remember the last time I've actually filled out a Form 1040 and submitted it to the IRS. I, like millions of taxpayers, use a vendor that created a program that walks me through a series of questions, and then at the end, it sort of magically, in my view, compiles all of this information into a completed 1040 with all of the exhibits. I don't even see the completed form until the end, and I click a button. I also, by the way, appreciate the fact that it pre-populates a lot of the information from what I had on my return last year, because for one thing, I have 6 kids and I don't remember all their social security numbers, so it's really nice. But this audience understands far better than me the possibilities that are out there. But in my simplistic view, I guess, of the world, it seems that that the SEC should be able to better facilitate similar technologies that would simplify the process for filing various types of SEC forms. And I guess maybe we should just take a page from Great Britain. It seems that they've already done that. But more importantly, I think if we can capture all of the information in a tagged format, it could be made more readily available to the market participants who trade shares of the company. And this has been mentioned earlier today by Congresswoman Maloney and others on prior panels. But smaller companies in particular are likely to see an increase in their analyst coverage if information about those companies becomes easier to access. And this should enhance the liquidity of those shares, which should make it easier for small companies to raise capital. So structured data, open data, has benefits for the companies that actually have to file that data. But now let's flip it around and let's look at the investor side. Investors would also benefit from having access to data that's interactive. Currently, if you go on EDGAR, the SEC's filing system, it's a real challenge to find a specific piece of data such as earnings per share within the relevant filing for the correct company. I mean, it's a little antiquated. And that challenge is magnified if the investor wants to establish trend lines from prior years, or they want to compare the performance of one company to the performance of other companies in the same industry. And so by tagging more of the data, the SEC, for one thing, could better control the display of information and layer it in a way that makes it easier for investors to navigate. Tools could also be created either by the SEC itself or through private vendors to provide helpful summaries and graphics and to improve the search and filtering capabilities, to highlight the changes from previous filings and to make lots of other improvements. Now, these improvements would enhance the usefulness of the data, first of all, for the individual investor who chooses to research an investment opportunity sort of the old-fashioned way by getting on the SEC's website and reviewing the company's SEC filings. But even more important, in my view, the structured data would improve the tools of portfolio and investment managers, of buy-side or sell-side analysts, of credit analysts, and of other sophisticated consumers of investor disclosures. And as you all are very well aware, smart and enterprising vendors can transform dynamic data into a wide variety of products that would help analysts mine mountains of data with just 1 or 2 keystrokes. And by giving these sophisticated market participants this type of capability, the SEC would help the individual mom and pop investor in at least a couple of ways. First of all, I think it's important for us to remember that an institutional investor like a mutual fund or a pension fund is essentially just a pool of retail investors. And so by giving the buy-side analyst these better tools to research the market, the SEC would actually benefit all the investors in the pool. Secondly, investors of all sizes benefit when we have efficient markets. And these sophisticated market participants facilitate the discovery of fair prices in the marketplace. They perform a very important price discovery role. Now, there are a lot of types of SEC filings that would benefit from structured data. We've talked about a number of them today. One that really sticks out to me is proxy statements. I'll probably give a speech on that some other time. But anyway, I think, and to be fair, the SEC has taken some really good steps forward in some of these areas with some of the filings, and especially as we move forward with new rulemakings and they kind of embed that into the process. But as the Commission undertakes this particular review that it's doing now of disclosure requirements under Regulation SK and Regulation SX, I think it gives us a kind of a golden opportunity to address some of the shortcomings of the data that we collect under those regulations. And I think we shouldn't just concern ourselves with the content of those disclosures and the content of the information that those companies have to provide, but we should also try to enhance the display and the usability of that information for investors. Otherwise, our efforts to improve disclosure are going to fall far short of what they could be. Now, structured data, at least for people outside of this room, is probably a pretty esoteric topic, and I gotta tell you, it's the kind of topic I never dreamed I would be speaking about at a conference like this. But I have become convinced that it is an important area of focus, not only for my office, but for the SEC as a whole. The SEC has a three-part mission, and that is to protect investors, to maintain fair, orderly, and efficient markets, and to facilitate capital formation. And in my view, the better use of structured data would help the SEC achieve all three of those important goals. So thank you. I really appreciate the opportunity to speak today.
Let's do one question. If you can grab the mic from over there. And for the next panel, I'll give you the time back, and I'll reward the entire audience with beer. Or rather, our sponsors will. So don't worry about that. Let's do one question. Any questions for Mr. Fleming? Yes, Lizette, in the front.
Thanks so much, Mr. Fleming. You mentioned about Edgar being difficult to use. You're the investor advocate. What are you doing to fix it?
So, as I mentioned, I think the disclosure effectiveness project that's underway in the Division of Corporation Finance kind of gives me that opportunity to sort of wedge myself into that discussion and make this case that we can't just look at the content in Edgar. We can't just, try to eliminate duplication. That while we're undergoing this review, a very important part of that review needs to be consideration of how that data can be gathered and dispersed to the general public. Because, the data is there for the benefit of investors, and we're really not taking advantage of that unless we can find better ways to kind of create a way to interface for investors to interface with that data.
Rick Fleming, thank you very much. Let's give him a round of applause.